Test, test. Good morning. Thank you all for being with us today. I call this hearing to order. Our startups, our entrepreneurs, our small businesses, the true engines of our economy, continue to experience a rigid lending environment. While large companies are turning to debt and equity markets to raise capital, small businesses all over the country regularly turn to conventional bank lending to finance their projects. At times, small firms cannot access conventional lending, so they have nowhere to turn for the capital to grow their business or create jobs. Despite being creditworthy, they often do not have the proven track record for traditional lending. Instead of turning away the next great American company, lenders can work with small businesses and provide access to SBA's numerous lending programs. We are here to talk about one of these lending programs today. The Advantage Loan Program, widely known as the 7A Loan Program, provides creditworthy small businesses the opportunity to receive capital if traditional lending is not available. The program, which is currently running at zero cost to the American taxpayer, does not provide direct loans. Rather, the SBA offers guarantees of repayments made to lenders. With the recent growth of the program in terms of loan approvals, loan amounts, and the congressionally authorized lending limit, it is important for our committee to comprehensively review the program. Does SBA have the correct tools in place to provide oversight? Where should there be improvement? Is the credit elsewhere test, the test which determines whether or not a small business is able to obtain capital from traditional options, strong enough? The hearing today will kick off a series of conversations focusing on the 7A loan program. Today, the subcommittee will hear directly from the lender's window, those financial institutions participating in the program. I appreciate each of the witnesses for being here today. I look forward to your testimony. I now yield to Ranking Member Adams for opening remarks.
Thank you, Mr. Chair, and I want to thank Ranking Member Velasquez for being here as well, and to all of our witnesses. With the economy showing continued growth, it's important to ensure that small businesses have the tools and the resources that they need to prosper. And in order for small firms to play their traditional job-creating role, a number of factors must be in place. Perhaps the most important ingredient is the availability of capital. Lending through the Small Business Administration is always critical for entrepreneurs seeking affordable capital to start new ventures and expand existing businesses. SBA loan programs fill a critical gap in the market for small businesses that cannot access traditional lending sources. In particular, SBA's 7A loan program is a public-private partnership that helps private lenders provide capital to small businesses that would not normally qualify for credit on reasonable terms. In recent years, 7A loans have experienced unprecedented growth, making this hearing particularly timely today. While over 64,000 loans totaling $24 billion were supported in fiscal year 2016, only 26% of 7A loans went to minorities, and only 18% to women-owned firms. This is simply unacceptable. In addition to these underwhelming numbers, the SBG OIG has identified lender oversight as a serious management challenge for SBA. The OIG first raised their concerns in fiscal year 2001, and the issue continues to this very day. As the 7A loan program grows, it's vital for the SBA to have the resources in place to conduct lender oversight and to guarantee that all entrepreneurs, no matter what gender or race, have equal opportunities to utilize the program. I look forward to hearing from our witnesses and gaining their insights on making the SBA's flagship program work even better for small businesses. It's vital that loans in the 7A programs are targeted to businesses who need them most, particularly those who've been unable to secure capital through private channels. Putting capital in the hands of businesses that need it most will help further the economic development of America's small businesses. So on that note, again, I'd like to thank our witnesses for taking time to be here. Your views and experiences, of course, will be valuable to the subcommittee as we consider how best to meet the entrepreneurs' capital needs. Thank you, Mr. Chair. I yield back.
Thanks to the ranking member, and this is such a bipartisan committee, and I really thank the ranking member for her support in being here today and her timely comments. If the committee members have an opening statement prepared, I ask that they be submitted for the record. I'd like to take a moment to explain the timing lights to you. You will each have 5 minutes to deliver your testimony. The light start sign is green. It will turn yellow. Finally, after when you have 1 minute remaining, that means start wrapping up. And finally, at the end of your 5 minutes, it will turn red. I ask that you try to adhere to the time limit. And in my first committee chairman, not make me tap you out today. Our first witness, I'm going to introduce the three, and then I'll allow the ranking member. Our first witness is Sonia McDonald. Ms. McDonald is an Executive Vice President and Chief Lending Officer for Randolph Brooks Federal Credit Union in Universal City, Texas, which is located in South Central Texas. She has been serving credit union members in various roles at Randolph Brooks Federal Credit Union for years, including numerous executive level and leadership positions. Along with being a recipient of the Presidential Volunteer Service Award, Ms. McDonald was named to the San Antonio's 40 Under 40 list and is a graduate of the University of Texas at Austin. She is testifying today on behalf of the National Association of Federally Insured Credit Unions. Our next witness is Ms. Cindy Blankenship. Ms. Blankenship is the Vice Chairman of Bank of the West in Grapevine, Texas. Having opened Bank of the West in 1986 with her husband, Ms. Blankenship has been a leader in the community banking for many years. Ms. Blankenship is a former chair of the Independent Community Bankers of America and has testified before numerous congressional committees. She has been recognized in the past as one of the 50 most powerful women in banking. Ms. Blankenship is testifying today on behalf of the Independent Community Bankers of America. Our next witness is Tony Wilkinson. Mr. Wilkinson is the President and Chief Executive Officer of the National Association of Government Guaranteed Lenders. For over 25 years, Mr. Wilkinson has been at the helm of the association, which represents the 7A lending industry. Before coming to NAGGL, Mr. Wilkinson was an executive at Stillwater National Bank. He has served as a member of the SBA's National Advisory Council and as a member of SBA's Investment Advisory Council. He has also been a recipient of SBA's National Financial Services Advocate of the Year Award. And I now yield to our ranking member.
Thank you, Mr. Chair. I am so pleased to introduce Ted Ashby, a native of Mount Airy, North Carolina. I represent North Carolina, and we're happy to have a Tar Heel in the place today. Mr. Ashby has a bachelor's degree in business administration and economics. He's held numerous positions in the banking industry, including branch administrator, chief lending officer, special assets manager, and senior vice president. In 1996, Mr. Ashby created Surrey Bank and Trust. As president and CEO, he has grown the bank to $278 million in assets, with 6 branches and a loan production office. He's testifying today on behalf of the American Bankers Association. Welcome, Mr. Ashby.
And again, thank you to the distinguished panel. And Ms. McDonald, you're recognized for 5 minutes, and you may begin.
Chairman Kelly, Ranking Member Adams, and members of the subcommittee, thank you for the invitation to appear before you this morning. My name is Sonia McDonald, and I am testifying today on behalf of NAFCU. I am the Executive Vice President and Chief Lending Officer at Randolph Brooks Federal Credit Union. In this role, I am responsible for a $6 billion portfolio that encompasses consumer, mortgage, and commercial lending. I appreciate the opportunity to share with you my experience with the Small Business Administration's 7A loan program. RBFCU became a SBA preferred and express lender in September of 2005. We are delegated with SBA authority and are able to offer all of their products. In 2016, we were the #1 SBA lending credit union in our 55-county district. SBA products allow us to leverage our lending dollars, mitigate the risk associated with the loans, and extend more credit to our community's small businesses. Our current portfolio has 232 active SBA loans with a balance of approximately $22 million. There are many stories of small business owners looking for that loan that will allow them to either start or grow their business. While other institutions may have scaled back their small dollar business lending, credit unions have been willing to fill that void. At RBFCU, we are pleased that we have been able to step up to help meet the demand. SBA 7A loans make it easier for credit unions because the government-guaranteed portion of these loans does not count toward the arbitrary credit union member business lending cap. In San Antonio, we have a great bagel shop, the Bagel Factory, owned by an Air Force veteran and his wife. They went to 20 different places and were denied before coming to Randolph Brooks for an SBA loan. That business is now in its 7th year and thriving. Another example is a loan we did for a 100% disabled military veteran. With the help of an SBA Express line of credit, he was able to secure 8A certification, and he can now fulfill software development contracts for the military. 2 years ago, NAFCU signed a memo of understanding with SBA to help address the challenge of getting more credit unions involved in the SBA. The MOU formalized a joint partnership that aims to increase the availability of small dollar loans by providing more outlets for entrepreneurs to access SBA products in their neighborhoods. And it makes the small dollar loans more accessible to underserved communities, including women and minorities. We appreciate the work SBA has done and have some ideas on how to make the program stronger. One area where the SBA can help credit unions is to provide clarity. Sometimes when we email the SBA directly with a specific question about standard operating procedures, the response is nothing more than a screenshot of the website. We have also seen an example of a loan submitted through general processing where the SBA processor didn't follow the SOP. It was a loan that required us to place a second lien on a borrower's rental property. Normally, we would use the tax-assessed value on the home, but in this case, the processor insisted we use the value estimated by Zillow.com, which was not anywhere in the procedure manual. If SBA would publish a best practices and clarify guidance, it would go a long way to helping credit unions when they are making SBA loans. At RBFCU, we would also like to see the length of time it takes to approve a loan shortened. Right now, it can take 8 weeks or longer. For RBFCU and other credit unions, it would also be beneficial if the new SBA One software better integrated with the lending software used by the majority of lenders, something the old software used to do. In conclusion, small businesses are the driving force of our economy and the key to its success. The ability for them to have access to capital is vital for job creation. While SBA's 7A program provides opportunities to established and struggling businesses, there are several relatively simple steps that could propel the program to its full potential, some of which the SBA can take without legislation. We urge Congress to do what is necessary to ensure these programs are successful. We thank you for your time and the opportunity to testify before you today on this important issue. I welcome any comments or questions you might have.
Ms. Blankenship, you are now recognized for 5 minutes.
Chairman Kelly, Ranking Member Adams, and members of the subcommittee. I'm Cynthia Blankenship, Vice Chairman, CFO, and Corporate President of Bank of the West in Grapevine, Texas. We're a $450 million community bank with 105 employees serving the Dallas-Fort Worth suburban area. I'm also a former chairman of the Independent Community Bankers of America, and I'm pleased to testify today on behalf of more than 5,800 community banks represented by ICBA. A robust 7A program with broad community bank participation will help small business thrive and create jobs. We are grateful for this committee's strong support of the 7A program. Bank of the West is a 30-year partner with the Small Business Administration and a leading SBA lender in the Dallas-Fort Worth district. We currently hold and service nearly $100 million in high-quality SBA loans with a minimum loss ratio. Historically, Bank of the West 7A loans have created thousands of jobs in the communities we serve and helped sustain and strengthen our local economy. Bank of the West uses the 7A loan program to supplement our lending and credit services by reaching a broader range of borrowers who would not qualify for a conventional loan. To safeguard the program from abuse, the SBA's Credit Elsewhere test requires us to fully substantiate and document the reasons a given applicant cannot be served with conventional credit. A typical conventional small business loan has a maturity of 1 to 3 years because it's funded with short-term deposits. However, 7A program loans have average maturities of 16 years or more The program even allows for loan terms up to 25 years. These longer terms lower the entrepreneur's loan payments and free up needed cash flow to hire, invest, and grow the business. When another recession occurs, the longer loan term may help many small businesses weather the crisis. Bank of the West has been a preferred SBA lender for 30 years. This program is available to lenders with a proven track record of successful SBA lending whose lending policies and procedures have been thoroughly vetted by the SBA. Once approved, a preferred lender can use streamlined procedures for processing SBA loans and make final credit decisions in-house. This is a critical advantage because it allows us to avoid a delay of up to 3 weeks at the SBA approval offices. As an SBA preferred lender, we can be responsive to our credit applicants, and if they qualify, provide the funds in a timely fashion. Stable funding is critical to the success of the 7A program and the thousands of borrowers who rely on it. While the program is fully funded by user fees, an authorization level must be approved by Congress each year, and once that level is reached, no more loans can be approved. The program authority came to an abrupt halt in the summer of 2015 when it reached its authorization cap well before the end of the fiscal year. Congress was forced to pass an emergency increase to the authorization cap to restart the program. ICBA greatly appreciates the support and responsiveness of this committee in passing that emergency increase. Thankfully, a hiatus was short-lived. A longer program shutdown would have cut off the thousands of small businesses that rely on the program for payroll, investment, and expansion. We must work together to ensure that the program funding is never disrupted again. One way we might better achieve this funding stability is by creating a 2-year funding commitment and have it be renewed every year. I have focused my remarks today on the 7A program. However, taking a broader perspective, I urge this committee to support regulatory and tax relief that would strengthen community banks and enable more small business lending in SBA programs and in conventional markets. ICBA's Plan for Prosperity is a robust set of legislative recommendations, many of which serve the same goal as the SBA, creating more small business credit that will in turn create economic growth and jobs. A copy of the plan is attached to my written statement, and I would encourage you to read it and discuss it with the community bankers in your districts. Thank you again for convening this hearing. I'm happy to answer any questions you may have.
Thank you, Ms. Blanket. It's always nice to hear somebody who does not have an accent. Mr. Wilkinson, you are now recognized for 5 minutes.
Good morning, Mr. Chairman, Ranking Member Adams, and other members of the committee. I'm Tony Wilkinson. I'm the President and CEO of the National Association of Government Guaranteed Lenders. And I'm happy to be here today to talk about the very successful SBA 7A program. It is a public-private partnership that works, as there are almost 2,000 financial institutions who participate in the program, reaching about 65,000 small businesses annually. These lenders make private sector loans to small businesses who are creditworthy, but fall into the well-known lending gap that small businesses face. Through the 7A program, lenders are able to meet the long-term financing needs of their small business customers. That means we can appropriately finance a long-term asset with a long-term loan. The significant majority of conventional loans, as Ms. Blankenship mentioned, have original maturities of 3 years or less, and the bulk of those loans actually have maturities of 1 year or less. So banks are really good at doing short-term financing, but with the SBA product, we are able to do long-term financing, again, financing those long-term assets with a long-term loan. And as Ms. Blankenship said, our original maturities in an SBA 7A program are 16 years. And so those longer maturities means lower payments for those small business borrowers. And when small businesses can get the financing that they need, they can expand and grow and create jobs. It has been estimated that well over 500,000 jobs are created or retained annually thanks to the 7A program. Over the last several years, use of the program has grown dramatically. Loan volume in fiscal year 2016 was over 25% greater than it was just in fiscal year 2014, meaning more and more small businesses are being served. But it also means we have been operating at or near our congressionally authorized annual authorization cap. This fiscal year, under the current continuing resolution, the 7A program has a $26.5 billion authorization cap. Based on current loan volumes and projected growth, we anticipate lending about $26 billion net this year. So again, we're going to be getting very close to our annual cap. I want to make sure we understand that that's a net number. Our gross lending will probably exceed the cap somewhat, and as loans, for whatever reason, don't get closed, they get canceled, and so we get down to a net number. But it's very likely that our gross lending will exceed our cap, but it is the net lending number that is important. As funding measures are considered with the April 28th expiration of the continuing resolution, a modest bump up in our authorization cap would be appreciated, just to make sure that we have sufficient funds to get through this year, as predicting future loan volumes, as you might imagine, is a very difficult task. Please keep in mind that the 7A program operates at a zero credit subsidy, meaning no appropriations are needed. The estimated costs of the program are paid for by the fees charged to lenders and borrowers. So let me repeat, no federal appropriations are needed to fund credit subsidies for this program. It is a long-held belief in our association for this program to pass the test of time, to be here for small businesses for many years to come. It has to be a program of integrity. The program must be used the right way. That is what we teach in our training programs. It is what we expect from our members, and it is why we understand that it is in the program's best interest to have SBA engaged in a sustained, efficient, and cost-effective oversight program to maintain that integrity. NAGLE has worked and will continue to work with the SBA and this committee and SBA's Office of Credit Risk Management to ensure that integrity. With that, I will close my remarks and be happy to answer any questions.
Thank you. And Mr. Ashby, you are now recognized for 5 minutes.
Chairman Kelly, Ranking Member Adams, and members of the subcommittee, I am Ted Ashby, President and CEO of Surrey Bank and Trust, headquartered in Mount Airy, North Carolina. I appreciate the opportunity to present the views of the ABA on the importance of the SBA Advantage Loan Program, widely known as the SBA 7A program for community banks like mine. Our bank was chartered in 1996 with a focus on business lending. We are intensely focused on building and maintaining long-term relationships with our customers. The success of Surrey Bank is linked to the success of our community. They are all our neighbors. Community banks like mine actively pursue small business loans, which is critical to the economic growth and job creation in our area. The SBA program supports this with the help to fill a critical gap, particularly for early-stage businesses that need access to longer-term loans. The guarantee helps reduce the risk and capital required for banks and facilitates loans that may never have been made without this important level of support from the SBA. In 1999, Surrey Bank began using SBA to help local companies meet their credit needs. This is an integral part of our business model. We have 174 active loans with an average loan size of $200,000, which demonstrates that the 7A program is very important to us and to our community. In total, 19% of our business loans are insured by the SBA, and 13% of all our loans are insured by the SBA. Our active involvement in SBA has earned Surrey Bank the Community Bank of the Year award in North Carolina 12 of the past 14 years. Let me give you a couple of examples to show the importance of SBA to our community. We extended credit to a precast concrete company that opened its doors in 2007, a terrible time to open. With the recession, economic activity was weak and the borrower had difficulty generating enough working capital to fund new orders. Our bank used the SBA's Capline contract loan program to fund these individual orders until they could be completed and the business paid. This company now generates sufficient cash flow to fund its operations without the SBA or bank assistance. My second example, we extended credit to a woman-owned company that's engaged in traffic and safety control in highway and bridge construction. This company started in 2004 with 4 employees and just 2 trucks. Since inception, we granted 23 SBA loans to this company to help fund their expansion. Today, the company has over $12 million in revenue, 90 employees, and a fleet of over 100 vehicles and assorted other equipment. Quite a success story. But our success is replicated over and over across communities in America in the banking system. This is why the ABA supports the small business committee's efforts to build on the positive aspects of the program and consider improvements that would benefit the business climate in our communities. I have noted in my written statement many positive features of the 7A program. The central focus of these features is that they reduce the cost of the transaction, lower general collateral requirements, provide faster response times, improve cash flow, and reduce the amount of working capital needed to operate the business. All of these facilitate loans that may have never been possible under conventional financing, where under conventional financing you would require an abundance of collateral. You have a guarantor that has a strong secondary source of repayment, and you would most likely have shorter loan amortizations. However, improvements can be made to any program. Primarily, it's involved in the servicing aspects. These include consolidating loans, allowing portfolio lenders to obtain a guarantee to avoid regulations on lunch-to-one borrower limitations, facilitating an offering compromise in cases where they may be in liquidation through multiple programs, and making the SBA One platform fully operational to reduce our paperwork. In conclusion, the SBA 7A program is a success and should be supported in the future. It has encouraged economic growth and allowed Surrey Bank to meet the credit needs of many small and diverse businesses in our small portion of the state of North Carolina. ABA strongly believes that our communities cannot reach their full potential without the presence of a local bank. Last year, 251 banks disappeared. Since Dodd-Frank was enacted, nearly 2,000 banks have merged or closed their doors. If the pressures on our small banks are not relieved, the loss will be felt far beyond the bank and its loss of employees for that bank. It will mean something significant has been lost in that community that was once served by the bank. That is why it is imperative that Congress take steps to enhance the banking industry's capacity to serve their customers and facilitate job creation and economic growth. Thank you. I'll be happy to answer any questions.
I want to once again just thank the distinguished members of the panel. Thank you so much for what you bring. I think one of the main things that is important to me, and I recognize myself for 5 minutes, so I'll hold myself to the same thing, but one of the most important things is this 7A loan program costs us, or costs the taxpayers, nothing. So I think that's very important. So it's a great program because there is no cost associated with, while creating small businesses or helping them to create small businesses, it doesn't cost. And this first question is for the entire panel. But I'll start with, I'll let Ms. Blankenship answer first, and then we can go along the list. From the lender's perspective, can you describe the credit elsewhere test and the steps you take to verify whether a small business can obtain capital from another source?
Well, we look at the credit elsewhere test and go through the parameters that SBA has lined out. And basically, that's how we qualify that small business as an alternative source of funding through the SBA. Many times, those small businesses aren't a good candidate for conventional financing because they don't have the collateral value, or they're depending on future cash flows, projected cash flows. We personally do a lot of startups as well as acquisitions for small businesses, and as well as some franchise. And a lot of times there's not a historical record there. And personally, I was able to give my hairstylist, Kim, a loan to acquire a salon when the owner died. She was a young lady. She had good credit, but didn't have a lot of collateral. So we were able to have her acquire that salon. She hired 8 additional stylists, paid her SBA loan off early, and that's just one story where the credit elsewhere test is a good tool, and we do use it so we can slot that customer in the right type of either conventional or SBA loans.
Yeah, and I guess for the public, the few people who are watching this hearing, is the credit elsewhere means you're not competing with other sources. If they can get credit in another place, then they have to do that. They can't use this program. They have to only use this if it's the only resource that they can use to get there. Is that correct?
That is correct.
Okay. Do one of you other three, anybody want to take a stab before I ask the next question?
Also speak to it from a credit union's perspective. We're no different than our friends in the banking industry. We look at the loan and we see, first of all, can we do it in a conventional manner? And if we can't, and it's usually because they don't have the down payment, they need a longer term, et cetera. But from a credit union's perspective, we follow the same rules as our friends in the banking industry.
And Mr. Ashby, I think you had a comment.
We don't specifically look at the credit elsewhere test. When we underwrite a loan, we're looking at the collateral coverage, cash flow, and secondary source of repayment. And a lot of the conventional financing is homogenized because the regulators like to know what our loan policies are, and all our loan policies are generally the same as you go from bank to bank. So it's rather, you can identify really very quickly which loans need this kind of support and help from the SBA on extended terms.
Thank you very much. Mr. Wilkinson, in your testimony, you described the PARIS, P-A-R-R-I-S, review system as a tool in SBA's oversight toolbox. What other tools does SBA and the Office of Credit Risk Management utilize to conduct lender oversight?
Sorry about that. Relatively new system that they put in place over the last 4 or 5 years, but it is an analytically driven program that they use then to target what reviews are going to happen amongst their lenders. And that's where then they can choose what kind of reviews which lenders are going to get. And it appears to be working quite well. The one issue that we would be concerned about is making sure that the Office of Credit Risk Management has the sufficient resources to do its job. With the growth we've had in the program, we need to make sure that their resources have increased commensurately so that they have the appropriate staff to continue to do the job that they need to do.
And I yield back myself the time that I haven't used, and I now recognize our ranking member from North Carolina, Ms. Adams, for 5 minutes.
Thank you, Mr. Chair, and thank you all for your testimony. Mr. Ashby, in your written testimony, you mentioned positive aspects of the 7A program and other SBA programs, including SCORE. Do you have any success stories or specific examples of how SCORE counseling has benefited small business clients, and what improvements can be made there?
My comments were primarily related to feedback that we have gotten from customers that have gone through that process, and they think it's very valuable to have someone that has basically fought the fight and learned how to navigate through their business careers and how to help these people overcome some of the obstacles that happen in their business, because we go through cycles, and some of these retired people have seen many business cycles. And so my experience is that we get great feedback. We're not present during those counseling sessions, but we do get feedback that it's most important to them to have a mentor.
Okay. Let me ask you, I had a listening session last week, some people would refer to as a town hall up in the upper part of my district in Huntersville, and we had a lot of veterans to come in to talk to us. Do you deal much with veterans? Have they been interested in the program through your bank?
We have had, I think we probably made 3 or 4 loans to veterans last year. There's a special carve-out for veterans on fees for loans amount of a certain dollar amount. So we do have interest from veterans.
Okay. You also note that the SBA One program platform is not fully operational. What enhancements should be made to the system?
Well, right now, basically, we can only get the issuance of the guarantee. And I think it was originally designed that you can go soup to nuts. You can do the initial qualification, and then you can print all the closing documents all on one platform. And so I guess the second half of that platform is not fully complete at this time.
Okay. To what extent, I mean, as a follow-up, has the SBA sought feedback from lenders to improve the system?
We get constant feedback from our district director, Lynn Duthette, in Charlotte. And so we're being called on all the time to talk about what types of loans that we're seeing. If we need any training, they oftentimes request Surrey Bank train some of the new people that are coming into the SBA lending arena, because we've been at it a long time and we're a small bank, and we try to help them get the proper resources, in-house in order not to run in trouble with the SOP and have problems going forward. So We have a good relationship with that office.
Great, thank you. Mr. Wilkinson, for a small business to participate in the 7A program, it must not be able to obtain conventional lending. How does a lender determine if a borrower cannot get credit elsewhere?
Okay, the credit elsewhere test is that the borrower cannot find financing under reasonable terms and conditions. So a lender will take a look at each small business borrower and determine whether it fits into their own conventional credit policies. But for instance, many of our credit policies say we don't lend to new business startups. In the SBA program, year to date, we're about 36% new business startups. So that's sort of one of the automatics that fit. As has been mentioned, sometimes it's collateral coverage, sometimes it's cash flow coverage. There are some statistical numbers that lenders look at, and perhaps if those numbers don't reach a benchmark that are sufficient for conventional financing, then they would be candidates for the SBA program.
Okay. Given that it's in the lender's best interest to make the determination that the borrower cannot obtain credit elsewhere so that it can make the loan, add to its assets or make money off of the loan, to what extent does a potential conflict of interest exist there?
Well, I guess the first thing is banks are in the business of lending money, and it is with every loan that they make, they hope to generate a profit from those. I think what you're referring to is the ability to sell loans into a secondary market where the banks can recoup the funds that they've lent plus generate a profit on those. Those loans that are sold are typically sold by lenders who have liquidity issues. Lenders who do not have liquidity issues typically hold their loans. That's why only about 40% of the loans in the 7A market are sold into the secondary market. Most of the loans, a majority of the loans are actually held and not sold.
Okay. All right, I'm out of time. Mr. Chair, I yield back. Thank you.
I thank the ranking member. I do want to recognize both our chairman, Chairman Shabbat from the great state of Ohio, and our ranking member, Velasquez from New York, and I thank both of them for honoring me by being here today. And now I recognize the gentleman from Kansas, Dr. Marshall.
Yep. Mr. Chairman, I'm so excited to be here. It's a breath of fresh air to talk about a government-private partnership that's working. I'm just here to celebrate. I needed a breath of fresh air. Thank you so much for the people that have made the effort. We need to keep accentuating the positive, and I appreciate several of you brought solutions. Ms. Blankenship talked about a 2-year funding commitment. What a novel idea to give you all certainty. I hope that the chairman and our staff take notes of these possible solutions. And Ms. McDonald, you talked about best practices. Give me the best practices and we'll do it. What a novel idea. Timeliness. These people that need the money, they need to get in the game now because 6 months from now may be too late for this business opportunity. You talked about software. Good luck with that. I've been fighting that one wherever I go. I don't know about you all, but my community woke up November the 9th, and it was a breath of fresh air. My entrepreneurs have been drowning in regulation, and all of a sudden they started popping up, coming out of nowhere. And Ms. Blankenship, have you seen an increased number of entrepreneurs out there since November the 9th? What's going on in the business world in Grapevine, Texas?
Well, I'm proud to say we have seen an uptick and a demand for entrepreneurs. And really, I think, personally, what I've seen coming through our loan committee, whether it be SBA or conventional lending, is there's just a renewed energy out there. During the crisis years, we saw a lot of our small businesses really pull back on expansion and putting investment and resources into their business because they didn't know what the economy was going to do. And I think there's a new confidence. We are seeing people that would not have taken a gamble on starting a new business or, just trying to acquire another business. We've seen quite an increase in that. And I think that accounts for the increase in the program. The program has been critical to us for 30 years. We have been in it. Some banks, we see players come in and out of the market, but we have been in it for 30 years. And I think the reason it works for us and some of the other people that stay in it is because you have to make a commitment and have your own resources in-house and just use the program as it was intended. and it's hugely
Well, thanks. Certainly, we
successful.
do understand commitments to your community to do these types of projects. Ms. McDonald, talk about agribusiness. I'm just curious, do you see much SBA loans like this for agribusiness, agriculture? Is that a big part of your market or not so much? That's too bad. Mr. Ashby, I'm not sure how rural you are. Do you see much in your agroeconomics going on with yours?
We have seen a lot of activity in the poultry industry, and we have participated, I think, probably, I think 2 or 3 loans last year. There is competition in that field with FSA.
Okay.
They also, USDA makes those loans also. But that was a large growth industry in North Carolina last year.
Okay. Ms. McDonald, let me come back to you. You talked about your bagel loan, and that's just a great, great story. Walk me through this business model just a little bit, and I'm sure you're not supposed to give me too many specifics. Mr. Ashby talked about a $200,000 average loan, but a business like the bagel industry, that's not a $400,000. I mean, are these $40 and $60, $80, $90,000 loans? Give me just kind of a feel for what your more typical loan looks like. Exactly.
Sorry. At Randolph Brooks, our average SBA loan is $90,000. So these are not high-dollar loans.
Let's kind of walk through the terms and differences between this and a more bank traditional loan. I mean, I've had some experience going through these. First of all, the differences are, does the SBA still guarantee 85% of the loan, or how much does it do now?
It depends on the amount. So if it's less than $150,000, then it's 85%. If it's more than $150,000, it's 75%.
Okay, and typically you would walk into a bank. These are kind of high risk loans. If they're a well qualified person, a bank might be asking 20, 30% down. How much down are these type of loans going to? How much?
So
capital?
at Randolph Brooks, our conventional loans are 20% down. With the SBA guarantee, it can be 10% down. And because we can extend the term, it makes the payment much more palatable.
Exactly. So you addressed the term. What about interest rates? As best as apples and apples, is it about the same as a conventional loan? Is it more? Is it less? Or
I mean, it's a little bit more. You're taking on the risk.
meaning a little bit more, like a half a point, 50 basis point, or what?
I couldn't answer.
The interest rates are statutorily set. There's a maximum rate of prime plus 2 3/4. The average interest rate today is running at prime plus 2.
Thanks, that solved it. Thank you.
The gentleman's time's expired. I now recognize the ranking member from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Ms. Blankenship, thank you for being here today, and it's really nice to see you again. I understand that SBA has been slow to fulfill their mandate to maximize the effectiveness of SBA Link and SBA One. It is critical that SBA is using the best technological solutions to do so. How important is it to community banks and other SBA lenders that SBA continues to streamline their processes using technology to maximize the usefulness of SBA Link and SBA One?
Well, I think especially for a community bank, timeliness is everything. So any advances and streamlining procedures that the SBA can finish up this SBA One and the link, it's not fully operational right now. We're using a third-party software, and we're basically running those parallel. And we do get continued and regular communication from SBA encouraging us to use SBA One. And, in talking to our lenders on the SBA side, that they're very encouraged by the final product should it become fully functional. But right now it is not fully functional, but it looks like it will greatly increase our efficiencies. It will increase our turn times, and I think someone mentioned that, funding is critical many times in these, especially in a small business startup or acquisition.
Funding is critical, and in terms of funding for SBA?
The funding for SBA is critical, but our ability to fund in a timely manner is very critical as well.
I agree.
Yeah.
Mr. Wilkinson, we have heard from many lenders about SBA's SOPs under lender guidelines. What is your view of those SOPs, and can they be improved?
Well, just as a point of clarification, there are regulations that SBA has issued over the years, and they're fairly short. And then in addition to those regulations, they have put out what they call standard operating procedure manuals, and those aren't so short. They're pretty thick, and those are the ones that we have to pay very, very close attention to. Sometimes those SOPs get changed rather quickly, and sometimes without notice. We see it from emails coming in from some of our members. But for the most part, SBA does try to work with us and find ways to streamline the program. If we go back to just fiscal year 2012, this was a $15 billion program. I tip my hat to the last couple of three folks that have been in charge of the Office of Capital Access at SBA. They were all former bankers. They understood our issues when we brought them to them and really worked to try to streamline it. So from a $15 billion program in 2012, and we have a request out for next year to make it a $30 billion program. So while the SOPs can be somewhat onerous and we pull our hair out sometimes in trying to figure out what some of the changes are, the fact is that things have gotten a lot better, and we're looking at an industry that's doubled since 2012.
Glad to hear that. Mr. Wilkinson, I know that several members today have raised the credit elsewhere test, but I want to ask you about whether or not you believe that there are instances where some lenders are not adhering to this test.
Could there be some lenders who are originating loans that could be done conventionally? I couldn't say unequivocally the answer is no. I mean, there's most likely somebody who has made a loan today where a borrower could get a conventional product. But that's where the role of lender oversight at SBA comes into play. As Ms. Blankenship described, every loan file has to explain why they cannot make that loan on a conventional basis, and they have to cover the things that cause that reason, be it the lack of collateral or the lack of a cash flow that meets their conventional standards. Perhaps it is because the borrower needs the 25-year maturity rather than the much shorter maturity that banks like to do on conventional financing. That documentation needs to be in the file, and if it's not there, and that lender goes to ask for the guarantee to be honored, chances are the answer is going to be no to the guarantee request.
Okay. Thank you, Mr. Chairman. I yield back.
I thank the gentlelady. I now recognize the great gentleman from Nebraska, Mr. Bacon.
Thank you for being here. I appreciate your time and traveling here. Grateful to you. And before I get to my questions, most of them are already asked, I just wanted to express my concern with your comments, Mr. Ashby, about the banks that are closing, our community banks and the consolidations. A lot of it result of Dodd-Frank. I think that's a underreported story, and we here should be concerned about it in Congress. And I mean, it's for our small communities, it's a bad trend, and I think we got to fix that. So I would have a commitment to help you out with that. On that note, with Dodd-Frank, when I talk to our folks in the 2nd District of Nebraska, I hear from the banks it's very hard to give small loans anymore. I mean, separate from the SBA because of the Dodd-Frank regulations. And I think that forces a lot of our small businesses to go to the SBA, which is government program and policy causing a problem and then using another government solution to help fix it. Is this a correct observation? Do I have that right? For anybody who'd like to answer?
Well, you know, our program has grown dramatically over the last few years, and I don't know that we could singularly say that it was because of Dodd-Frank. I think there are a lot of things. The economy is improving. There are more entrepreneurs looking to borrow today. Our loan volume, our growth is up year to date about 7 to 8% over last year. Are there provisions of Dodd-Frank that are pushing lenders to shrink their conventional credit box and expand their SBA box? I would say the answer is probably yes. To what extent, I couldn't quantify that.
Okay. Anybody else want to comment?
At Surrey Bank, we don't think there's as large a business opportunity in lending to individuals for personal needs as there are in small business lending, because these regulations are very complex, and the risk of running afoul of those regulations is significant.
One more question. I think each of you touched on it just a little bit, but I'd love to have clarity for, together. If you could say or tell us one thing you would like us to help improve with the SBA and the 7A process, what would it be?
I would like to see us be able to refinance an existing SBA loan on our books. We probably lose 3 to 4 loans a year because the rules will not allow us to take out another SBA loan, and it becomes particularly cumbersome when it's been sold into the secondary market. But as a result, we end up losing not only the customer, but the deposits. So the deposits go out of our community bank. That's deposit dollars that could have been leveraged into other loans and expansion into the community. And that's really a key obstacle for us right now. So we would like to see that refinance rule
Thank you. It's
revisited.
great input. Ms. McDonald?
Well, as I mentioned earlier, it would be great to have any unwritten rules or best practices published so that we don't find out after the fact. It would save us a lot of time. It would save the SBA a lot of time.
I think everybody would like that.
Yes.
Yeah, any job they're in. Mr. Wilkinson?
Well, mine's more at a programmatic level. You know, over the last few years, we've bumped into our authorization cap repeatedly. And we had proposed, last year, it was included in the budget request for the current year, has been approved by OMB and actually was introduced in the Senate as potential language, to give the administrator of the SBA the opportunity to increase our authorized cap with notice to the appropriations committees by a certain percentage, 10, 15%. So, for instance, this year, she could raise it another $3 billion or up to $3 billion with notification to the Appropriations Committee, so long as the program is operating at a 0 credit subsidy, so no appropriations are needed. It would give us that flexibility so we're not worried about, did we guess exactly right on the amount of loan volume we're going to see 18 months down the road? Because that's a hard task to do. And with that kind of flexibility in the authorization cap, it would make my life a lot easier.
Thank you. And with about the 40 seconds remaining, Mr. Ashby.
We're a portfolio lender. We're a small bank, and so I'm kind of a small bank advocate. But I think one of the things that changed this past year was the inability for banks to write an SBA loan if it would get over their loans to one borrower limitation. And in a lot of these small communities that may have $100 million in assets and say $8 million in capital, that doesn't give you a very large loan limit that you can make to some of these customers in your market that may actually need that loan. So I think for portfolio lenders, it would be great if there could be a carve-out for certain size banks.
Okay, thank you very much. I appreciate your recommendations, and I yield back.
The gentleman yields back. If it's okay with the panel, I think we're going to do another round of questions. Ms. Adams and I have both agreed. Is that okay with you guys? And so I'll recognize myself for 5 minutes. My first question is, and we kind of talked around this, but is the credit elsewhere test, is it strong enough? And I would just like to hear your comments on that. Mr. Wilkinson, I guess we'll start with you.
Well, I think it is. Clearly, it's raising a lot of questions here on the Hill as to whether it is or not. But I think from the lender's side, we understand that we have to document in the file why that borrower cannot get conventional financing. And that's, could we put some other language in statute to make that even more clear? That's a possibility, and we'd be happy to help draft some language with that. But it's pretty clear in our books. We teach what SBA means by credit elsewhere and the things that are detailed out in the SOP on how you document that.
So you feel like it's strong enough and it's clear enough that you understand it and it's the right test right now. Is that correct?
I understand it, and I think our members understand it.
Ms. Blankenship?
I think it works for us right now. If you look back at our historical volumes, they didn't increase or decrease because of this test. And remember, when you're a small community bank, you have a fiduciary responsibility to your customer. I mean, we go to church and schools, our kids go to school together. We can't take advantage of our customer. So it's our job to put that customer in the right finance tool to get them their credit availability. Our reputation and integrity is riding on this as well.
Mr. Ashby, do you agree?
I agree. When you look at our percentage of loans that we have with the SBA guarantee that are business-related purposes, it's 19%. And so when you just look at the broad category of business opportunities in our area that is not as vibrant as others, that's a very believable percentage.
And Ms. McDonald.
I think everybody has said it really well. We have a fiduciary duty to do the right thing, and I think everybody here agrees with that. We have to be able to note in the loan file or document the reasons that we went with the SBA, and if we're ever audited, we can confidently give the information.
Thank you, and I'll start with you again, Ms. McDonald, since I left you the last. My second question is does the SBA have the correct tools in place to provide oversight?
I think so. We have a very good relationship with the SBA. We're constantly talking to them about ways to improve the process. So I would say yes.
Mr. Ashby?
Well, SBA has had explosive growth over the last few years. You know, I think they're doing a good job. Mr. Wilkinson spoke to the Paris score, and I don't know if those are confidential reports sent out quarterly to the banks that are participating in the programs, but they cover a lot of important things: your performance, the asset management, regulatory compliance, risk management, and any special items and risk factors that the SBA sees out there. So I think it's well done.
And either one of you two are welcome to comment.
Well, just as a preferred lender, you know, we have to have integrity in our portfolio and meet certain standards and not go over loss ratios. So I think that the oversight it's working for us now. With the growth in the program, you may need to enhance the resources at SBA, but for players like us, I think we're not feeling lack of oversight.
You know, I think it's a critical part of our business. We have a conference call every other week with the Office of Credit Risk Management to talk about issues that are out there. We stay very focused on oversight. Do they have enough tools and resources? We would like to see them. They had approved prior to the hiring freeze 6 full-time equivalents to come on to be the lead auditors. Right now, they hire contractors to do those. Hopefully, when the hiring freeze is lifted, SBA can hire their own staff that's dedicated specifically for doing those reviews. We hear from our members that a lot of times they're training the consultants on what they ought to be examining that lender for, which doesn't seem to work well at all. So we're hopeful that they'll be able to get that done. We know that SBA, that the Office of Credit Risk Management is supposed to get a certain allocation of resources every year. We would like to make sure that the Office of Credit Risk Management is actually getting those resources to make sure that they do have the tools necessary to stay on top of our growth.
And I yield back, and now I recognize Ms. Adams.
Thank you, Mr. Chairman. Ms. McDonald, credit unions are a vital part of our nation's lending to small businesses and share the same mission, people helping people. How can Congress make it easier for credit unions to participate in SBA loans, SBA programs?
Well, I think we have to look at raising the member business cap. At Randolph-Brooks, we're 6.5% loaned out, so we're not near the cap, but there's a lot of small credit unions out there who can't get into SBA lending because as soon as they put in the resources and spend the money and spend the time, they get a couple of loans and then they would have to shut down their program.
Okay. Encouraging more credit unions to participate in SBA programs is critical to serving many businesses in underserved markets. So what impact will increased credit union participation mean to small firms?
Well, it gives people the opportunity, it gives credit unions the opportunity to serve their members. I mean, that's why Randolph-Brooks got into member business lending. Our members were asking for this type of loan. And so the more players that are out there able to offer these loans, the more you're going to have them in the communities that we serve.
Mm-hmm. Let me ask, do you all recruit members, or how's that? You say your members are asking, and I'm just curious.
So we have membership, and we've served them for their personal loans, their auto loans, their mortgage loans, and some of those same members, because they trust us, have come to us and say, you know, we'd like to do our business have our business needs served by you.
Okay. Do you do any special outreach, or it's kind of,
Not particularly
Word of
for,
mouth.
for business loans. It's really, we outreach for members, and then they come to us for their business needs.
thank you. Ms. Blankenship, in your written testimony, you note the increase in authorization for the 7A program that was required in July 2015. Could you please elaborate on the importance of stable funding and the proposal for a 2-year funding commitment?
Well, when our loans go to a loan committee and we approve those loans, and let's just say it's 30 or 60 days in advance of closing the SBA loan. So at any given time, we have approved loans that haven't closed. And as Mr. Wilkinson said, sometimes those loans fall out for whatever reason, they end up not closing. But we have this listing of loans that our loan committee has approved, and we've told the customer was approved. But then in order to get it fully funded, you know, we have to get the authorization from SBA. And so you're always fighting. We're trying to project too into the future how much funding will be available based on the total market demand. And it's continually and annually a challenge that is, I think, particularly a challenge for smaller community banks and other SBA participant lenders. And if we could go to a 2-year funding, that would give us, the regulators like to see us plan and do our risk assessments annually, and it would just help us with our funds management, our liquidity, and our funding needs.
Okay, thank you very much. Mr. Wilkinson, what efforts have the National Association of Government Guaranteed Lenders made to expand the universe of small business lending to traditionally underserved markets?
Thank you for that question. We have been working diligently with the SBA on what we call our Smart Business Toolkit. It's a program that we put together to help small businesses understand how to get credit ready. And we have paid for the underwriting of that course and have given it to SBA. We've had it translated into Spanish. We've been working with the Urban League to get that program out into their membership as well. We've had veteran outreach programs. We take lending to underserved markets very seriously, and I think it's showing in that the numbers across the board are up in many of the underserved areas.
Okay, great. Thank you very much, Mr. Chair. I yield back. My time's up.
I thank the ranking member and gentle lady from North Carolina again. Thank you for today. Thank you, witnesses, for being here today and sharing your thoughts and views. I believe it's important to hear directly from lenders participating in the program. Your role is extremely important to our hardworking small businesses that are striving every day to create themselves and to grow, to expand and create jobs for others in my district, in the ranking member's district, and in districts all across this great nation. It's vital that the 7A loan program operate in an efficient manner and on behalf of all our small businesses and the American taxpayer. We will use this conversation from today as we continue to review and examine SBA's loan programs. I ask unanimous consent that the members have 5 legislative days to submit statements and supporting materials for the record. Without objection, so ordered, this hearing is adjourned.